Welcome back to Be Rich. Today I'm going to talk about an article that came up on the Financial Times. It talks about collateralized debt obligations, CDOs. These, or you can call them CLOs, collateralized loan obligations. What basically Wall Street bankers did is very ingenious. Exactly what they did in 2008 when the going is good, and the last 2 years the Federal Reserve kept cutting interest rates and flooding markets with liquidity. Most of the institutional investors, mainly insurance funds and insurance fund managers, and also pension fund managers, were hungry for yield. They were willing to buy anything that would give them yield well above the benchmark rates at that point of time. So, what Wall Street bankers did is obliged by them giving them rates in higher than what they would get in junk bonds. What they did is very simple. They got corporate loans of higher yielding corporate loans and put it all together with private equity loans. Basically, private equity companies which took loans, leveraged buyouts to buy out companies. Since the federal rate was zero, all this was very exciting, and therefore, this was all pulled together with senior grade and junior grade papers, and these were giving high yields, and they were packaged off to insurers and other institutional investors who were very hungry for yield. These guys lapped it because in loose monetary policy was there, and in loose monetary conditions nobody defaults. The relevant S&P in 500 index has dropped only 1%, and since the Fed was committed to keeping interest rates low to make sure that there will be higher employment and did not be keen on fighting inflation last year, these products were very popular and sold quite a bit. But now the chickens have come home to roost. These products are excellent when there is a low interest rate regime and the Federal Reserve does not plan to increase interest rates. Unfortunately, inflation genie is out of the bottle after 40 years. The Fed was sleeping on the wheel for so long and did not act on it. And so when the Fed started to act, it acted at a vengeance. It followed up with a 25-point bip raise, with a 50 bip raise and a 75 bip raise. Within no time, interest rates which were at zero have been now reset to 1.5 to 1.75. The Fed has also indicated that it will follow a restrictive monetary policy where demand would be restricted. The first in those line of fire, if demand is restricted, is private equity loan companies because they never make profits, and therefore interest will be a claim on cash flow and will push the company further down the tube. It's like asking Oyo or Vola to pay interest. They have to pay it out of cash flow because both of them are not making profits. Both Oyo and Vola have taken venture capital debt and private equity debt. This is the debt that has been packaged along with corporate debt in these notes. Also, what will happen when interest rates go up? Consumer demand and consumer confidence will start to ebb. When consumer demand and consumer confidence starts to ebb, the purchasing will have not happen at the store. In fact, the higher interest rates will dampen the need for the consumer to buy stocks, to buy consumer goods, and this will have a negative impact on companies' profits and ability to serve interest, and which will drag the market down further. So far, the insurers who have bought these loan papers have nothing to panic about because except Revlon, now there's been no major bankruptcies yet. But unfortunately, the rates are increasing day by day as the Fed continues to increase interest rates. Recently, Intertape, a privately held company financed by venture capital, decided to borrow money instead of selling equity. Their senior debt, which is sold ahead of junk bond, was placed at the average loan was placed at 14%, and their senior grade was priced at 8.5%. These are extremely high rates and will not allow the company to survive if these rates are enforced. But capital is scarce to find both for equity and debt. A startup company or a company which is low on cash flow can find only debt. If interest rates are so high at this very early stage, what will happen when even if the Fed decides to do its own rate and rate increase and stops at 4%, many companies will go belly up, and this will mean lot of these leverage bonds will fall. And once these leverage bonds fall, there will be a lot of pain in the market, because it will be insurance companies and pension holders who will be in trouble. The Federal Reserve is responsible for this kind of mess, because in a defined pension plan, the pension fund managers have been forced to be looking for yield where there is no yield available in the market. The Federal Reserve, the European Central Bank, and the Bank of England have run a very loose monetary policy over the last 2 decades, deliberately keeping interest rates low. In fact, before this inflationary crisis broke out, the Bundesbank issued bonds. The Bund was already trading in negative rate, has just turned positive, with inflation climbing to 8.1% in continental Europe. Germany will has a constitutional mandate to maintain inflation after their experience in the Weimar Republic. Therefore, the US and Germany will push the rest of the world for higher rates. Higher rates means these interest rates which I talked about will be reset, and the value of the bond will drop. This will make bond markets very nervous. In fact, if interest rates go up, the value of the bonds have to fall by equivalent number so that the yield is maintained. This will mean huge losses for insurance companies. At this time, there seems to be a calm before the storm, because interest rates have not really shot up yet. But already the pain can be felt in the loan sector, in the housing loan sector, where housing loan rates have surged from nearly 1% to 5.26% in a period of month, making house buying practically unaffordable in the United States. Thank you for watching. Be rich. If you like the content, kindly consider sharing with your friends and relatives. You press the subscribe button of my channel and turn on the bell notification. If you do not turn on the bell notification, you will not be notified every time we put out a video. Once again, I thank you for your support to Be Rich. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.